Let's set the scene plainly. Markets are near their highs, headlines are loud, and dinner table conversations are back to, "Did you see what tech did today?" That kind of energy usually makes people nervous. And I get it. But I want to start with a different lens. Markets climb on imagination, yes, but sometimes imagination becomes real. We're living through a step change in capability. AI moving from demos to deployment, companies rewiring workflows, productivity stirring after a long nap. If prices feel rich, it may be because the underlying economy is in the middle of a transformation that old models underestimate.
And I want to start with the whisper that matters. Valuations don't shout, they whisper. When the averages feel unstoppable, the message from valuation tends to be, this is the part of the movie where the risks are invisible right up until they aren't. By a range of long-term measures, many would place today's valuations in the upper ranks of history, the kind of altitude we approached around 1929 and 1999. History doesn't hand us a calendar, but it does hand us a map. Starting from high ground usually means the long road ahead offers less return and more exposure to sudden weather.
Fair. But maps can change when the terrain changes. In the late 1990s, we had dreams but not the infrastructure. Today, the infrastructure exists. Cloud, chips, models, public and private data pipelines, plus a corporate sector that's shown remarkable adaptability through a pandemic, supply chain rewiring, and rate shocks. Yes, multiples are elevated, but maybe they reflect a world that's fundamentally changing. Every era of disbelief has given birth to a new normal, and sometimes the new normal isn't a mirage. It's margins holding, it's new revenue streams, it's productivity that finally shows up in the data.
I'll grant that productivity might be the wild card, but we shouldn't skip the arithmetic. The empirical record across decades. Think of the academic work around cyclically adjusted earnings and long horizon returns shows a strong relationship. The higher the starting valuation, the lower the expected return over the next decade or so. It's not a day trader's tool, it's a long horizon compass. And right now, that compass suggests we're on thinner ice. If earnings growth under-delivers, if rates don't fall as quickly as people hope, or if the AI narrative takes longer to translate into dollars, the downside is asymmetric. There isn't much cushion.
Let's test that cushion. Corporate balance sheets are cleaner than many expected after the rate spike. A lot of debt was termed out, cash balances are still healthy in aggregate, and many management teams have found efficiencies, automation, supply rationalization, better pricing strategies. Meanwhile, demand hasn't collapsed. It's normalized in areas and surprised in others. The market might be paying up not just for growth someday, but for the resilience we've actually seen. And we shouldn't dismiss the idea that certain companies command premium multiples because their economic moats have widened, from network effects to AI-enabled cost advantages.
Resilience is real, but concentration is too. Breadth is narrow, meaning a small set of very large companies is doing an outsized share of the lifting. When leadership is that concentrated, you're effectively tying the market's fate to a handful of narratives. Great when momentum is your friend, painful if anything cracks. And we've seen some cracks. Rolling leadership, momentum divergences, fits of volatility beneath calm indices. To put a sharper point on it, the technical internals aren't flashing an all clear. The Hindenburg omen isn't a mystical crash predictor. It's a barometer of market disunity. When new highs and new lows surge together, it tells us the surface strength of the indices hides internal weakness. Historically, when that happens alongside extreme valuations, the market's risk of an abrupt correction jumps. Lately, we've seen a flurry of those signals. Clusters that say the market is not moving in harmony.
I hear you on breadth. But let's remember how new technology cycles often look. Early on, leadership is narrow. The picks and shovels players and the platforms capture the gains while the rest of the economy adapts. In past cycles, that breadth gap eventually closed as adoption spread and second derivative beneficiaries emerged. Software that rides the new hardware, services that monetize the capability, sectors that reprice risk with better tools. If AI-enhanced productivity really is diffusing, we may be in that stage where the leaders run first and the followers catch up with a lag. Technical indicators can flag stress, but they're imperfect timing tools. We've seen narrow markets broaden before without collapsing first.
They are imperfect, but they deserve a hearing when paired with valuation stretch and tightening financial conditions. This is where the plumbing matters. Policy rates are still restrictive compared with the last decade. Quantitative tightening drains liquidity from the system. Treasury issuance competes for capital. Credit spreads may be calm now, but they have a way of waking up quickly if growth expectations wobble. We're sprinting uphill with a backpack full of debt. public, and for many companies, still meaningful private. That weight raises the sensitivity of the system to shocks.
And yet, despite that backpack, the economy hasn't buckled. Labor markets are cooler but still functional. Wage growth is moderating without collapsing. Headline inflation has come down from peaks, even if the last mile is bumpy. Fiscal investment in semiconductors, infrastructure, and energy transition is real and multi-year, which can cushion cyclical dips. If growth cools too quickly, the policy reaction function is there. Not a promise, but a pattern. And we've seen that central banks can adjust course. Markets price that optionality. Yes, liquidity is tighter than the free money era, but perhaps we're finding a sustainable equilibrium rather than running off a cliff.
Sustainable equilibria require sustainable earnings. Let's talk earnings. Many companies navigated cost inflation with pricing power and supply normalization. But pricing power fades as inflation cools. Costs like wages don't roll back easily. If volumes don't re-accelerate to fill the gap, margins compress. Guidance has been mixed, resilient in some corners, cautious in others. If you're relying on growth to justify these valuations, you might be assuming a lot. And if that growth doesn't show up, much of the upside may already be priced in. That's the asymmetry. When expectations sit on a pedestal, even good news can disappoint.
And yet some of the growth here isn't just volume, it's efficiency. Companies can deliver more with the same headcount, automate rote tasks, accelerate product cycles, personalize at scale. Those gains end up in margins. The AI CapEx cycle, from data center build-outs to software, isn't merely spend, it's investment in capacity. Historically, these investment waves lay the tracks for future productivity and profitability. Skeptics called the early internet spend wasteful, until it wasn't. Yes, not every dollar earns a return, but the enduring platforms birthed during those waves reshaped cost structures and revenue models across industries.
The internet analogy is useful and cautionary. The platforms that survived were a small subset. Many others disappeared. Investors who owned the index rode a round trip they didn't enjoy. That's the broader point. Even when a technology wave is real, markets can dramatically overpay for it in the short run. It's different this time is the reddest flag of all, not because change isn't real, but because the phrase tends to be used to justify ignoring the math. History doesn't say when a drop happens, but it does suggest that the risk of large drawdowns goes up under these conditions. Markets rarely fall because people panic. They fall because people stop believing.
To me, the distinction is critical. Don't ignore the math, but don't ignore the shift in the production function either. A structural change argument isn't a hall pass, it's a hypothesis to be tested against profitable use cases, adoption curves, and cash flows. If those deliver, valuation can normalize via the E rising rather than the P falling. Markets can and do stay expensive longer than people expect. That's not a forecast, it's a pattern. And it's why trying to time a top using valuation or technicals alone has humbled many smart folks. The world moves, companies adapt, and what looks unsustainable can persist while fundamentals catch up.
Which is precisely why this moment matters for ordinary investors. The index in many retirement accounts is heavily skewed toward the largest companies, the ones leading the rally. Narrow leadership means a single idea. AI will pay off brilliantly and soon is now a large part of many people's savings story. If that idea takes longer to cash flow than markets hope, your 401k balance doesn't just feel the market's wiggles, it feels a concentrated factor unwind. On the credit side, if spreads widen and rates stay sticky, borrowing costs for cars, homes, and small businesses rise. That's the wallet impact. Markets aren't an abstract scoreboard. They seep into everyday life through prices, jobs, and the cost of money.
And if the AI productivity wave does deliver, households could benefit through the other side of that ledger. Lower cost to produce goods and services, faster drug discovery, smarter logistics, more competitive small businesses leveraging AI tools. That's real economy stuff that can lift living standards and help growth outrun debt servicing. Think of a teacher who uses generative tools to tailor lessons, or a nurse who spends less time on paperwork, or a manufacturer who halves defect rates with computer vision. Those gains don't show up in a P/E ratio immediately, but they ultimately support the earnings that justify today's valuations.
No disagreement that the potential is enormous. The question is cadence. Markets are pricing a relatively smooth handoff. soft landing, steady disinflation, earnings acceleration, and swift monetization of AI. That's a tight choreography. Any stumble, a hotter inflation print, a geopolitical flare that disturbs supply chains, a policy miscommunication that tightens liquidity, and the thin ice becomes very visible. Combine high valuations with a weak technical setup, and you're essentially on thinner ice. Any slip in fundamentals or shifts in sentiment can lead to larger falls. These are the conditions where corrections out of nowhere aren't actually out of nowhere. They're the release of tension that built up quietly.
So how should people think about that tension without turning it into fear? I'd frame it as an audit, not advice, just an audit of assumptions. What has to go right for the story you're leaning on to hold? Is the timeline reasonable? Are there alternative paths where the story still works, just more slowly? The broader economy has buffers, household cash cushions, corporate efficiency, policy flexibility, but individual portfolios need a buffer too, and that's a question to ask. What is my buffer if earnings disappoint, if rates rise, or if the AI productivity payoff is delayed?
Exactly. Ask the questions now, not in the middle of a downdraft. The risk isn't just price volatility, it's sequence risk. When the order of returns matters because you need the money at specific times. For retirees or near retirees, a 20 to 30% drawdown early in the distribution phase can have outsized effects compared with the same drawdown a decade earlier. I'm not predicting that drawdown on a timetable, but this is the kind of environment where the probability of a large move increases. And again, timing is treacherous. Valuation and technicals are not clocks, but they do tell you how far you are from the ground if you slip.
The market's leadership concentration is another layer worth unpacking for that audit. When the top names dominate, it raises the stakes on their execution, but it also reflects their scale advantages, data moats, distribution, capital to invest through cycles. In previous decades, the rise of platform companies also forced a re-rating because the durability of cash flows improved. That's part of today's argument for higher multiples. Some businesses are structurally less cyclical. I don't think that's hand-waving. It's embedded in subscription models, switching costs, and ecosystem lock-in.
Durability is a fair claim, but it isn't invincibility. Regulators, geopolitics, supply constraints, and competition can change the slope of those cash flows quickly. And on the topic of internals, those Hindenburg-Omen clusters we mentioned, think of them as the market telling you that under the surface, there's disagreement about the future. It's like a choir where half the singers go sharp and half go flat. The melody still carries for a while, but the discord grows. Historically, that kind of disunity at elevated valuations is not where you want to ignore risk, even if, to your point, it isn't a deterministic crash signal.
On liquidity mechanics, I'll add a nuance. While quantitative tightening and higher rates are headwinds, global liquidity is not monolithic. Cross-border flows, sovereign wealth, and corporate cash management can offset parts of the drain at times. And if inflation continues to grind lower, the policy debate opens. Markets can rally on the expectation of relief even before relief arrives. That's part of why valuations feel stretched today. They're pulling forward hope. If the hope is partly realized, not perfectly, but credibly, the current multiples can be rationalized without fireworks.
And if the hope is deferred, there's a lot of air under the feet. That's the fork in the road, and there's risk on both paths. My job in this conversation is to underline the conditions that make the downside path more slippery. Top decile valuations by many measures, narrow breadth, momentum showing cracks, liquidity that can tighten faster than people think, and a nexus of macro and geopolitical variables that are not within any company's control. History doesn't say when a drop happens, but it does say that the risk of large drawdowns goes up under these conditions.
And my job is to remember that markets are discounting mechanisms forward. They try to price the future, not the present. Every cycle has had its chant of too expensive, and sometimes that chant was right, sometimes it wasn't. The optimistic case today isn't blind cheerleading. It's a view that the mix of innovation, corporate adaptability, and fiscal industrial policy creates a foundation for earnings to grow into valuations. The skeptics are right to press for proof. The optimists are right to see that the proof is starting to appear in use cases and deployments, not just in press releases.
Let's end by bringing it back to the person listening who doesn't live and breathe this. Here's the translation. If you hold broad market exposure through an index fund in your retirement account, you are more exposed to a handful of very large companies than you've ever been. That can be a great write-up. It can also magnify a reversal. If credit gets more expensive, you'll feel it in loan terms. If sentiment shifts, companies may pull back hiring or investment, and that has job market implications. The stock market isn't the economy, but it is a signal and a financing channel for the economy. Shifts there ripple outward.
And here's the hopeful translation: progress compounds. We underpriced it a decade ago when we thought low rates were the only game in town. We might be overpaying for it in pockets now. But the broader arc bends toward higher capability, and societies that harness it can get more out of the same inputs. In a way, this whole debate is healthy. It forces a collective due diligence. Maybe valuations cool without drama, maybe innovation outruns skepticism, or maybe we get a pothole and climb out. But we'll do it with more tools than we had before.
Before we sign off, I'll echo one mantra. Markets can stay expensive longer than many expect. Timing remains extremely difficult. Technical indicators and valuation metrics are imperfect as timing tools. The market could still run for some time before rolling over. But that shouldn't blunt the message. Valuations don't shout, they whisper. And they're whispering that the farther you climb without a net, the more careful you need to be about your next step.
And I'll echo a counter. Yes, valuations are rich, but maybe they reflect a world that's fundamentally changing. The task now is to separate sustainable change from hype, to watch the internals for signs of strain, and to keep asking the right questions. It isn't about declaring "it's different this time" as a slogan. It's about measuring what's actually different and deciding how much to pay for it.
Amen to that. Skepticism is a seatbelt, not a brake pedal. Optimism is the fuel, not the steering wheel. You need both to get where you're going.
And with that, we leave our listeners with the same three-part thought. Understand the price you're paying, understand the story the market is telling, and understand the buffer you have if the story takes longer to play out. The future always arrives. The question is how bumpy the ride is on the way. This dialogue is an informational synthesis of the provided news and is not investment, legal, tax, or financial advice. No recommendation or solicitation is being made.